The US dollar just crashed to its lowest level since early 2022, plummeting nearly 10% since Donald Trump's inauguration in January and erasing the post election rally that followed his victory in November 2024. That's 3 years worth of price action erased in just 3 months, and a reversal that nobody saw coming. Many analysts predicted that Trump's tariff heavy economic policies would strengthen the dollar. That's what tariffs typically do, by increasing demand for US goods and attracting capital to American markets. In January, Trump's Treasury Secretary Scott Bessent said that tariffs would strengthen the dollar, offsetting any inflation that happened as a result. But that's not what we're seeing play out. The dollar is seriously weakening. And we've actually seen something like this play out before. Here's the Dixie after Trump's first election in 2016. See the similarity? Here we see a post election rally which peaked in January, followed by a long decline which continued for the whole year, bottoming out in February 2018. 12% lower than a year earlier. So far, the Dixie is repeating itself since Trump's second election. In this video, we'll dig into what might be in store for the dollar, a long decline, or another surprising reversal to the upside. But first things first, we need to find out what's going on here. At this inflection point where the dollar turns around in mid-January, the question is, why is the world's reserve currency collapsing when Trump's tariffs promise strength? Well, if one word sums it up, it's uncertainty. For example, US trade policy uncertainty is off the charts, the highest level ever recorded. That's been the dominant theme driving the market this year so far. This previous spike came during Trump's tariff hikes during his first term. Why does that matter for the dollar? The dollar's value is tied to the perceived strength of the US economy, and uncertainty has led to a pessimistic outlook for the US economy in the near future. That's been bearish for the dollar. And several measures are indicating a souring near-term economic outlook. Here's a big one: consumer confidence. This index is sinking fast. It plummeted in April 2025 to its lowest level since 2021. And that's a big red flag. Consumer confidence often slumps like this before recessions hit, like here prior to the Great Financial Crisis, or the dot-com bubble recession, or the early 1990s oil shock. Another red flag comes from unemployment expectations, which are up 5 straight months, reaching the highest level since 2009 during the Great Recession. Again, spikes in this indicator often precede recessions. Speaking of recessions, consumers and investors are now bracing for one to hit sooner than previously thought. JP Morgan raised their odds of a 2025 recession from 40% to 60%, and that's largely being driven by the uncertainty surrounding tariffs and the ongoing trade war. Weak economic data could increase the likelihood that the Fed will lower interest rates this year to boost growth. The latest market expectations are showing 3 rate cuts in 2025, bringing the Fed funds rate from 4.33% today to 3.41% by December 2025. Lower interest rates are bearish for the dollar because they lower the yield on US Treasuries, making them less attractive. Investors look elsewhere for higher returns. One bright side here is that a weaker dollar isn't always all bad. In fact, there could be some benefits to the stock market. Around 40% of revenue for S&P 500 companies comes from overseas, up from just 15% in 1980, driving home how globalization and free trade have bolstered US corporate profits. And a weaker dollar should be bullish for corporate profits. That's because a weaker dollar makes American products more affordable to foreign buyers, boosting demand. When the dollar weakens, those earnings in euros, yen, and other currencies translate back into more dollars on the company's financial statements. But an escalating trade war and increased trade barriers threaten the international flow of capital that makes this process work. So it's yet to be seen if this plays out as expected. Now, looking ahead, the key question is how long the dollar decline might last. We could very well see the dollar continue a long slide like we saw in Trump's first term and break below this long-term trendline support dating back to 2011. This is possible if the trade war persists or even escalates. Tariffs keep rolling out, breeding more uncertainty and fears of higher inflation and slower growth. The S&P 500 could fall from its current level, reflecting heightened recession risks. A weakened dollar combined with the higher prices and reduced consumer spending could push the US economy into a recession by mid-2025. Investors would likely shift to safe haven assets like gold and the Swiss franc, selling off US stocks and bonds. But on the other hand, if trade tensions ease and the Trump administration provides greater clarity on its tariff policies, the dollar could regain some or all of its lost ground, particularly if the Fed delays rate cuts in response to improving economic data. Reduced recession fears would attract capital back to the US, bolstering the dollar. While a weaker dollar could provide some benefits, such as bolstering exports, the broader risks of trade wars and a slowing economy loom large. Whether the dollar stages a comeback or continues its decline will depend on the trajectory of Trump's trade policies and the resilience of the US economy. For now, markets remain on edge, and the world is watching to see whether the US can navigate this turbulent period without slipping into a deeper crisis. As we move further into 2025, one thing is clear. The dollar's fate is intertwined with the broader health of the US and global economies. Investors, businesses, and policymakers will need to stay vigilant as the trade war saga unfolds. At Capital.com, we'll keep you posted on the dollar and market trends. Subscribe for more insights. Thanks for watching.